Hello and welcome to the Weekend Investing Stock Market Weekly Review for the week ended 13th of June. The last two sessions of the week have been a bit weak, and post the market closing on Friday, we've had the Israel-Iran conflict uh, go into you know complete next level mode with the attacks from both sides. And only Monday will tell us how much damage to the market this will cause. Um, there is also news that uh, the Honduras channel has been closed, and that perhaps is going to impact 20 to 30% of oil supplies. And I talked to some oil experts, and they say that oil going to triple digits is not out of the books now. So, with that background, I think some tough times perhaps may be upon us, where we may react very strongly in the coming week on this potential oil spike that may happen on Monday itself. Um, Not sure how this will play out, how long this conflict will elongate, but I'm hoping that by the end of this weekend, some sense will prevail on both sides and some kind of a ceasefire may happen. But nevertheless, what we are seeing is that you know geopolitics is becoming more and more messier. The world is not a peaceful place as it was some time back, and something or the other keeps playing the uh, on the conflict books at all times, and hence more and more need for proper asset allocation and having hedges in place is required. India, of course, is in a fine fettle, I would think. We are growing well. We have inflation under control. We have domestic flows doing well. And we have growth prospects uh, verified and ratified by not only RBI but IMF and other agencies. So there is no reason to believe that we are not on the right path. But the external environment is such that the path can be a bit bumpy. So with that in mind, let's go ahead and see what all the charts have to tell us for this week. From our research desk, we had all these fantastic stories, lessons from Asian Paint's multi-decadal journey, why holding cash can be risky, the mutual fund mirage, why gold could outperform equities in coming years, gold versus yields, broken correlation in changing world, how increasing money supply is affecting growth, why market forecasts often fail, how long-term investing increases your chance of higher returns, the $5,000 gold forecast, what past bull runs have revealed, and public versus private banks, how the trend has shifted over time. Some very nice, interesting stories to go over and increase our knowledge on. Disclaimer as always, please read the disclaimer fully and understand it, and do subscribe to the channel if you haven't so far. The chart for the Nifty on the daily chart, you can see 4 days of going nowhere, and then fifth day massive drop, but trying to come back up. Still 1.14% down for this week. So net this week was a negative week, and you can see on the weekly chart that we have stalled at this level for the last 5 weeks now, and we are not able to go forth. So more consolidation perhaps needed before we make the next move up. S&P 500 has also stalled minus 0.39% this week. And it is very surprising that an economy which is being called out for, being at close to recession, uh, inflation, runaway inflation, very high yields for their historical perspective, and all kinds of problems for the US market. Yet the market is at a new high within a new all-time high distance. That tells you that despite whatever be the narrative, always follow price. The price is telling you that even despite all these problems, perhaps the liquidity is so much that it is not able to let the prices go down, and perhaps there's going to be even more liquidity that is going to get pumped in, which is getting factored into the markets, that we may make new all-time highs on the US markets also. Gold was up 4% this week, of course, fueled by this Middle East crisis, and likely to go up much more in the next week also. So we have closed above 10,000 per gram for gold for the first time ever. This is the highest weekly close, and anytime a chart closes at a 52-week or an all-time high close basis, you can very well imagine that it's a very, very strong statement for the bulls. The dollar index is falling uh, as expected and as engineered by the US government also. They want the dollar index to fall, and it is falling very, very hard. In the benchmark indices, you can see all frontline indices fell down. Small caps nearly 0.5%, Nifty 500, Nifty 50 almost 1% down, mid cap also 1.18% down, and Nifty next 50 down the most at 1.5%. In the sectoral overview, you can see capital markets, which have been running, fell 4.3%, tourism fell 3.4%, real estate 3.1%, public sector banks 2.3%, FMCG 2.3%. These were some of the bigger losers of the market. You had pharma gain 1.4%, media gain 1.2%, and IT gained 3.2%. Only three sectors in the entire landscape had any gains. The momentum score quilt looks like this over different periods. When you calculate momentum score, you find that defense, capital market, central public sector enterprise, private banks, oil and gas, these have the top five ranks, with defense and capital market really ruling it. But in the very short term, they are losing those positions. Pharma, oil and gas, central PSCs, media, IT, these have been the ones which have really come into focus in the short term. FMCG, tourism, consumption stocks, auto, MNCs are all at the bottom, and you can see they have consistently remained at the bottom for a long period of time. In the weekly advanced decline stats, Nifty not so bad, almost half 52 to 48, but rest of the market is more biased towards declines this last 1 week than advances, and that is also expected given the nature of the move that we've had. In the percentage of stocks outperforming the benchmark, Nifty still has 62% stocks outperforming Nifty. Nifty Next 50 also has 66% stocks outperforming benchmark, so that is very good, both of these two. But the other indices is a poor score where under 50% or nearly 50% is the outcome of stocks outperforming benchmark. In the drop from 52-week high, Nifty has now almost 70% stocks which are within 20% of the fall, and uh, almost 88% of stocks within 30% of fall. So most of the stocks from the Nifty basket are skewed towards lesser fall, whereas as you go down the market cap, you can see that mid caps and Nifty Next 50 as well are largely skewed towards 20 to 40% bracket, whereas small cap and mid caps are still skewed towards 20% to 50% bracket. So still a large part of the market is still bleeding very heavily when you compare it with the 52-week high. Is the trend improving? Not at all. We are having a very flattish 50-day uh, trend. So number of percentage of CNX 500 stocks above 50-day moving average has remained consistently at 80%, which is not bad by itself, but it is not improving. And only 40 odd percent stocks are above 200 DMA for CNX 500, which is also not improving. In the trend check in sectors, percentage of stocks above 200 DMA, let's say, we only have financial services, private banks, which have some significant number of stocks above the 200 DMA. Other than that, metals, services, consumer durables, infrastructure all have nearly 50% of stocks above 200 DMA, so which is not so great. It is very near the CNX 500 average. But then there are sectors like IT, PSC, energy, oil and gas, and media, which is really poor, where only 20 to 30% stocks are above the 200-day moving average. In the FII DII stat space, you can see 2 days of buying at in FIIs and 3 days of selling for this week. And in the DII space, you had 5 days of buying in DII space. So good buying from domestic institutions in the last five sessions. In the last 1 month, FIIs are now net negative 2,000 crores, whereas domestic institutions are positive 96,000 crores. So it is entirely been run by domestic institutions. And the silver lining from FIIs is that their net negative selling is virtually zero, which is a contrast from previous months where net negative selling was much higher amounts. So even if they are not buying, they're not selling much net, whereas domestic institutions are continuously buying. So that's the situation right now. Next week likely is going to be more challenging, I think, but let's hope for the best. And I'll see you next week. All the best. Bye.